Two Bulls in a China Shop is brought to you by these great companies that are giving us money to let you listen to their stuff.
Bullshit, Kyle. We make this show. You and me. Two Bulls in a China Shop is brought to you by us.
Someone's got to pay the bills, Dan, because it's not our trading.
All right, roll them.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome, everyone. You've made it to the China Shop. We've got a special guest interview episode for you today. I'm Shopkeeper Dan. With me, as always, is Kyle, creator of financialineptitude.com. Kyle, how excited are you today for this interview?
I am really excited. And I feel bad because I should have been prepping for this one a lot earlier. But it's not very often we get a good options guest on. And this one looks like it's going to be a really fun one.
Yes, that's right. We are joined by CC Lagator from Options AI. How are you doing today, CC?
I'm doing great. Thanks for having me on.
So is your name literally two C's or is that like an abbreviation?
It's Calvin Christopher, but I've gone by that my whole life. So it's sort of a great screening method. You know, if somebody's calling up asking for Calvin, I know they're like looking for money or something.
Yeah.
Oh, brilliant.
Very nice.
I was just thinking of like CC's Pizza.
He's not here.
So tell us a little bit about yourself, CC.
Sure. Yeah. So I my first job out of college was as an options market maker. And, I wasn't the type of, I wasn't one of those kids that in high school and college was reading the Wall Street Journal and, really obsessed with the stock market. Mm-hmm. But this opportunity came up and I had gone to school in Philadelphia. And my only sort of entree into that world was we used to like late at night, we'd go down to Atlantic City when we had nothing.
Okay.
So I had this, these sort of basic, cards versions of probability and statistics and all those sorts of things. And then it turns out, that's exactly what the job is. Mm. And in a lot of ways, when you're on that side of the business, and it's strictly math and probability, it can sometimes hurt to know a little bit too much, the markets. And there was a guy I used to trade with at my old company. I think he was trading some symbol like HBO or something for years before he realized it wasn't like the TV network. But that's the sort of thing, because you're sitting there and you're making markets in like 250 symbols. And for you, it's all about risk and reward and probability. And, all of those things get boiled down into Greeks and all that sort of aspect of options. But basically, at the end of the day, all you're doing is balancing, the amount of risk you're willing to take on as a market maker. You're trying to like constantly produce edge in every trade you do. Mm-hmm. And then you have to, fly by the seat of your pants to manage it all, to try to capture all of that edge you've created before it all expires. Right.
Does that mean that you're like kind of similar, like an odds maker, like for a bookie? Like
exactly. You're exactly like a bookie. Right. Uh-huh. And so if somebody is, you're a bookie and there's a million games going on at once. Right. Mm-hmm. And so you're seeing it all through like this very broad, sort of prism. But it is, I think I often compare options. It's as if like a horse race, you have like the long shot, it's 30-1. And then you have the favorite, which is like 2-1 or something. And the options market is basically all of that odds that simply, but then you can bet and close and open positions all the way through the race until it ends. Right.
Right.
And all of those odds are changing. And that, that's sort of, buying that really far out of the money option is like the long shot. And then, selling at the money premium is like the long, is the favorite. And yeah, so going from, that into that job, you learn all of these things. And over the years, I started getting involved with a little bit more of options education and started seeing it a little bit more from the retail side of things and how they were seeing this market. And at some point, I teamed up with another friend where we were two of the three co-founders of Options AI, and he came from the institutional brokerage options side of the business.
Oh, okay.
And we sort of, we set out to address what we saw was kind of broken in the retail options market. And basically it was that retail options flow looks very different than institutional flow. And, we set out to try to fix that.
Why is that?
Well, there's a couple of reasons. One of them is just, one of them is unfortunately kind of regulatory, which is if you're getting into, let's say you have like an E-Trade account or something, and you wanted to get into options, they basically start you with some really basic trades. You're allowed to buy a call, you're allowed to buy a put. Unfortunately, those are really the lowest probability trade.
I think we had that same conversation.
Yeah.
The way you onboard into options is here, do a bunch of bad trades first.
Right.
And then you get the good stuff, right? Which is kind of fascinating. And then the other aspects of it are along those same lines. I mean, the regulators do that for a reason, which is they don't want people getting in trouble. They don't want them risking more than they can understand. Sorry, what were you going to say?
Oh, I was just saying, I was agreeing with what you're saying about the onboarding process, because Dan and I both used Thinkorswim's platform.
Yeah.
And they start you out the same way. You can do naked calls, naked puts, but
right.
You need the next tier in order to do the one that's the really good one, the cover calls and cash secured puts. And
yeah.
Why are the less risky trades? Why do you need more qualifications to take less risk?
Yeah, and part of that is, you understand the reasons behind this is they don't want people getting into risks they don't understand, right?
Right.
And so that risk they don't understand is, I have always felt it's a much easier hurdle than it's made out to be, which is if you are buying a call or buying a put, the reason they start you with that is you're all right, I buy a call, stock goes up, call goes up, right? I buy a put, stock goes down, call, people can wrap their head around that. And I think people find comfort in that. And then what confuses them is they're I bought a call, this stock went higher, and the call didn't really go very high, or it didn't go as high as I thought it would. And that's what really trips people up. And so when we started, when we got into building what would become Options AI, we were all right, well, how can we tell the story of these other trades? These level 3 trades is what they're called, regulatory wise. And that's basically, how can I both think of options as both buying and selling options? And, one of the ways to do that is by packaging very easy to understand multi-leg option strategies. And those are, instead of buying a call, buy a call spread. Instead of maybe that buying a call spread, maybe sell a put spread. And then maybe combine that all together into something like an iron condor where, I could potentially make income if the stock goes sideways. And so all of those things we felt were much easier to explain visually, and that, that a retail audience that wants to use these things in their everyday investing, it shouldn't be like this wall of numbers with all this fear.
Can we take just a second to step back in case some of the listeners aren't familiar with some of these terms?
Yeah.
Just real quick, what's the difference between just a regular put and a credit spread or a debit spread?
Yeah. So the easiest way to think about it is, let's say if, let's even use numbers. If a stock is trading 100, you could buy a call, let's say the 100 call, and maybe it's trading $4. You need the stock to go up to 104 or above, at expiration to make money on that call. You've paid $4 for the right to only pay $4
right,
for the chance for that stock to go higher, right? Now, the problem with that is that clearly, if you need a stock to go $4 higher, you're starting from under 50% probability of that happening, right?
Right.
And what the simplest first multi-leg spread to understand in a lot of ways is, well, what if I, instead of paying that $4 for the chance of infinite money if the stock went higher, what if I just defined a zone where I think it's realistic that the stock could go higher? And so what a call spread is buying that 100 call and let's say selling the 110 110 call. And so let's say that 110 call is trading $1.50. Well, now I'm in that call spread for $2.50. Now I only need the stock to go up by $2.50 instead of $4. I've increased my probability of that happening because it going to 102.5 is much higher probability than 104. And the only thing I've given up is that if the stock goes to like 120, I stop participating above 110 because I've sold that 110 call.
Reducing risk for less gain, less potential gain.
Yeah, you're playing, you're shooting for doubles instead of home runs, right?
Right.
And in general, that's a very good way to think about all markets and all trading, right? It's I can count on one hand the times I've like just had some surprise lottery ticket type experience in options. The majority of it is all those singles and doubles and all adding up.
It's funny because I think most people get into options for that lottery ticket too.
They want the home runs.
Oh yeah. It's so, that's exactly, people are like, oh, what if this happened?
Right.
And the problem is you have to do those trades 20 times before the one happens, and it can become death by 1,000 cuts, right?
Yep.
So anyway, that's like the most basic, multi-leg option strategy is if you understand that, it's like I'm basically creating a zone between 100 and 110. And that spread can be worth anywhere from 0 to 110, and I'm willing to pay $2.50 for it and make up to $7.50, right?
Right.
So then the easiest way to now explain a credit spread is it's the same trade. You were just on the other side of it. So the same way that you could buy a stock for 100 and it could go up forever, or you could short that stock at 100 and it could go down to 0. So selling a spread is the same way. So if that spread is $2.50 and you sell it at $2.50, you're risking $7.50 to make that $2.50, right? You're betting that the person buying that spread is wrong and that the stock's going to go lower or sideways. And that selling options in that manner is above 50% probability of profit because the chances of something happening are less than 50% than something happening the exact opposite way or nothing happening at all, right? So anytime you're selling options, you're starting from above 50% probability. And this is where I think a lot of people get into a little bit of trouble is they're like, oh, that's great. Well, so why don't I just go in and just sell options constantly? And the issue becomes is if you're not doing it in a very defined risk way where you know exactly if things went wrong, you know exactly how much it could go wrong.
You don't want to be paying the lottery ticket.
You don't. Yeah, exactly. Yeah, you don't want to be the guy on the hook for the Mega Millions, right?
Yeah, exactly.
And so that's exactly why, and this to circle back to, Options AI is we've built a platform so that people could do these types of trades, buy that debit call spread instead of buying a call, sell that credit call spread instead of buying a put and at a high probability, but do it in a way where they're looking and they're being like, okay, I'm risking $700 to make $300. I understand that, right? And if the stock were to go to 150, I just lose my $700. I'm not on the hook and I don't have to sell my house. And those kinds of packages. But I feel like when you explain it in that way, where you can either buy this $10 spread or sell this $10 spread, and it's the same trade. It's just what side of it you're on. Then a light bulb moment goes off with people, and they're like, "Oh, well, that means I can start using these types of trades and think about it as I have a portfolio that's worth whatever amount of money." I could be doing credit call spreads all over the place, right?
Yep.
And I could be attempting to add income. Or, a couple of weeks ago in the market's down big. People are starting to you're like, man, I kind of feel like I want to own Amazon at 100 or whatever it was after the split.
Right.
But I'm kind of, I don't want to just load up on Amazon stock because what if it, this bear market keeps going? And it's and also, people are going crazy and the market's crashing. Well, what if I just sell some credit put spreads in a bunch of these stocks I like? And if the market keeps going down, I lose a little bit of money and live to fight another day. But if it goes up, I just did this very high percentage, high probability strategy instead of just going out and buying a bunch of stocks. So those kinds of things we think is, it should be more straightforward for the average investor.
I also noticed that, you do have a lot of educational content on your website too. I think I was just looking through trying to read up on an iron condor since you mentioned that earlier. And for some reason, I still have never actually looked that up to see what it actually is.
No, the iron condor, it's great. We had one guy tell us one time, he's like, I have no idea what an iron condor is, but I want to be an iron condor trader.
Just because it sounds cool.
Sounds like an action movie.
We're like, can we use that in advertising?
Right.
So basically, an iron condor is, I explained that, credit call spread earlier. So imagine like $100 stock, and you wanted to sell a call spread up above where the stock is trading, and you wanted to sell it at 105, right? So you wanted to do like the 105, 106 credit call spread. At the same time, an iron condor, all that is doing the same exact thing on the other side, on the put side. So you'd be selling the 95, 94 put spread.
Okay, so you're betting on sideways action.
Exactly. So you've now created a range in the stock between 95 and 105 that you basically, the credit you sold that iron condor at, you get to collect the entire thing if the stock stays between 95 and 105. And it's a great income strategy for even against, like, if you owned that stock. I think it's a great income strategy. I personally like it a lot more than like covered calls and things like that. And you could just do it on your own. So the way that works, what's interesting about an iron condor is, let's say you sold that credit put spread at 30 cents. And let's say you sold that credit call spread at 30 cents. If you had just done one of those on its own, you would be risking 70 to make 30, right? Like that explanation earlier. When you do it both at the same time, you are now actually only risking 40 to make up to 60 because the stock can't go both ways, right? So if the stock goes up to 110 and you blow out on the call side of the spread, that put spread is max gain, right? So it covers you to some extent. You're still lost on the trade. It broke your zone, but you're always going to win on one of the sides, and you're rooting to win on both of the sides. And that's an iron condor. I mean, it's simple. And again, it's like one of those things where it sounds terrifying, and then people are talking about gamma and vega and all that kind of stuff. And it's like, wait, I understand. I want a stock to finish between 95 and 105, and I'm risking X to make X or Y to do that.
Right.
And, that's what we do is we look at that and say, you should be able to see that visually on a chart. And that's sort of the center of the Options AI experience, which is you see a chart and then you see that trade laid out in the future, and you're literally rooting for it, the stock, almost like a, what was that old like Pong game? Remember that?
I think it was Pong, wasn't it?
You wanted the ball to stay in between those two things. Yeah. It's like you're like, okay, I get it. Like, and now the stock's down approaching my put, and I'm seeing it play out over time. And should I manage this? Should I close it early? Those types of things. We think it's much more intuitive for people to see it on what they're used to looking at, which is stock charts.
I like that. I watched a video of you on YouTube kind of walking through like how the platform works. And that was one of the things that I really liked that you showed on there was you looked at one of your open trades, and it was showing how it was like, approaching your max gain already, and then an earning event coming up. Yeah. And then making the decision to close it out now instead of, because there's no more risk for you, right? If you're already almost capped out, but you can visually see that on the chart now. Yeah. There's no guesswork or panic.
Yeah. And that's one of the big things, again, going back, I don't want to like bash the options Greeks the whole call, but it's, if you've sold that iron condor at 60 cents, which is an unrealistic price, by the way, but that's what popped into my head. Okay. Let's say you did it at 50 cents. If you had already made, let's say the thing was now trading 10 cents, it's getting very late. You did it 3 weeks out and it's in the last week, right? Mm-hmm. So now all of a sudden if you just close it right there, you've made 40 cents, right?
Yeah.
And then you've got like an earnings coming up a day later, and you're like, do I wait around for this last 10 cents or do I, just close this and take my winnings? Like, it's very easy to see that when you're looking at it visually with those updated metrics is you're now risking 90 cents on that last 10 cents. Right. And you're willing, you could turn a winning trade into a losing trade. And so that kind of trade management, we also want to be extremely intuitive. It's like, I shouldn't be like looking at, what's my gamma for the next 3 days in this trade and all. It's like, it's 10 cents. Like, what do you need to know about it? Right.
Right. So what's the difference? Like, when a market maker is like putting on the, like filling the book, basically, because that's what you're doing, right? You're creating liquidity for everybody else. I'm assuming that's why sometimes you see like options that don't have a lot of interest. They have like a really wide spread.
Yeah.
So that's you who's putting in that like $2 spread.
Yeah, I wouldn't have. That's Citadel. That's Citadel. No, that's okay. No, that's exactly what it is. So basically, if you think about it from like a stock market making, right? So if I'm making markets in stocks on the NASDAQ or something, and let's say I was also making markets in 200 and some stocks, it's pretty straightforward. It's, it's 250 bids and asks that I have to produce in those stocks with a ton of retail flow in between that bid and ask. So if you go to buy a stock like Apple, and you're doing it on your, platform at home, there's a pretty high probability that you're getting paired up with somebody that's selling Apple at the same moment. Right. And all that stuff's happening in an equity market. When you then go into the option side of things, even in Apple, you've got thousands of strikes and dozens of expirations, spread out over the next 2 years. Mm-hmm. The chances of you putting in an order exactly at the same time of somebody else doing it 3 months out in Apple, $20 away from where Apple's trading, it's next to zero, right?
Yeah.
Right.
So that means that options market makers are pretty much on the other side of your trade almost all the time. And it's a competitive market, and they're all trying to, if they want that order flow. And the way they're doing it on their end, and this is very important for the people that are, trading options and wondering how all this works, is that bid and ask is a public bid ask, and it's probably somebody different on the bid than it is on the offer. Mm-hmm. And every person, every market maker, let's say there's 20 companies making a market in that option, they all have something called what they'll call fair value. Right. So let's say that you go to your screen and you're looking at a call and it's like $1 at $1.30. Right. There's a bunch of people whose fair value for that option is 115. There might be some people that are like 110. There might be other people 120. And that's dependent on the exact inputs they're putting into their model at that moment. Mm-hmm. But it's also based on what their other positions are in that stock. Right. So somebody might be willing to pay more even than like where the center point of that option is, because they just sold something nearby at a much higher value. And so what the market maker's doing all day long is they're trying to build up edge. If they have fair value of 115 on an option and somebody sells it to them at 110, they're trying to lock in the edge, not necessarily on that option, especially if it's illiquid. But there's another option nearby, let's say in that same expiration, that they have valued at $1 that somebody's willing to pay 105. And if they sell that at 105, they've then created 10 cents in edge, right? Uh-huh. And then that's sort of how they make money. And they're trying to do that all day long. And then they have to manage the sort of resulting positions that it's left them with. And that's where all the gamma and vega and all that sort of thing comes in. Mm-hmm. And that is basically they're trying to ride those positions into expiration and capture as much of that 10 cents that theoretical 10 cents they've just created.
Mm-hmm.
They're trying to ride that in and capture as much of that 10 cents as possible.
So is that why sometimes when like I'm trying to close a position out, but there's not a whole lot of liquidity on the markets, like if I set my bid or set my ask price to like right in the middle of the bid ask spread, sometimes it'll just sit there, and then if I drop it another penny, it gets snapped up instantaneously. Is that the market maker grabbing it, or?
We've actually built a trade ticket, so Options AI has a trade ticket around that exact concept that you're talking about. Options are wider, right? There's less liquidity, and you should not be hitting bids and taking offers unless you absolutely have to.
Right.
And what you should do is exactly what you did. You should put it in the middle with that, there's a 25% chance there's somebody out there willing to pay for it. And not only that, but like they have to represent you in a single leg. They have to represent you. And there might be in a heavily traded option, it's just a matter of time before somebody else does retail wise comes and trades the other side of that. Right.
Right.
But you should absolutely try to find that liquidity. You should start at the center and you should walk it lower if you're selling, or you should start in the center and walk it higher until you're filled. And you're basically finding out when, and I'm referring to market makers as if they're sitting there staring at their screen, waiting for your order. Right?
I assume it's an algorithm of some sort.
Exactly. So they have it. You're starting at 115 and you walk it up to 120 and you trigger one of their things saying, I'm willing to sell this at 120. And they weren't showing it. They were showing it at 130.
Yeah.
But they are in a competitive market and they can't let that pass up if they really need it. You know what I mean?
So what happens if you were to market order then? Do you just go to the what's ever on the book, or do you get like I've always wondered how that actually works. Like when there's hidden liquidity there, do you execute at that price, or do you actually execute at whatever the market is?
I think it would depend on the width. If there was something like the one you described earlier, where it's like $2 wide, right? Like
mm-hmm.
It depends, right? Where it got routed to, what exchange it got routed to, if it got put into auction, and all of these like weird intricacies of the markets. But if it got shown and it got shown into a competitive auction, then the people are going to price improve.
Yeah.
Because somebody wants that thing. If it gets routed into something where basically only one guy sitting, who knows where, is the only guy making a market on that, then you might get filled on the bid or the offer, which really sucks, right?
Right. Okay.
So even there, you have to think about it this way: is I would still, even with that order, walk it down. He's, his algorithm, that person's algorithm, is probably not going to wait until you hit the bid.
Mm-hmm.
They're going to fill you before that. So I would just say 100% of the time, unless you're in like a jam and you've really got to get out of a position and the markets are going crazy. And even then, I wouldn't put in a market order. We don't even allow it on Options AI. Put it that way.
Oh, really?
Yeah, we don't allow market orders on options because 85% of our orders are multi-leg options.
Mm-hmm.
To put that in as a market order would just be insane.
Right.
So we encourage you to start in the center. Like it pre-fills out your ticket at the center, and we show you a visual representation of the current market, and it sort of nudges you to walk it up or walk it down.
What are some of the other improvements that you've made in order to help retail? Like, what are some of the other issues that you've seen that Options AI helps address? Yeah,
well, I think one of the big things is, and I was mentioning Greeks earlier. The Greeks are there, like on the Options AI platform. You can see them all. You can see these, how these things are translated into sort of the traditional language. But we really focus on probability of profit and risk reward. Mm-hmm. And it's sort of going back to those explanations I was doing earlier, is that when you are doing one of these defined risk credit spreads or defined risk debit spreads, you should be looking at this as a risk reward and probability of profit scenario. And one of the things we have is, we have like a trade scanner where, let's say, you were looking at, you had a shopping list of 5 of your favorite stocks that are all getting hammered in the market. You can go in and put in, I want to see credit put spreads in these 5 stocks on this, 2 weeks from now at a probability of profit of roughly 70%. right? And it's going to generate those 5 trades. It's going to pick those strikes that represent that probability of profit. And then you can just quickly scan those and be like, you know what, I'm going to do that Amazon one, or I'm going to do the Amazon and the Netflix one. And that's just sort of like the mindset that you should be having. And then, by the way, when you're clicking that trade, it's showing you a visual representation of that trade. You can be like, oh, that's right near that low, that former low in that stock. I really love that put spread there, that credit put spread there.
Right.
So, and that's the other thing, is that this sort of visual trading is that, when you stare at an options chain, first of all, up is down and down is up. Like, it doesn't really make any sense intuitively.
And there's so many strikes.
Yeah, and there's
so many.
The wall of numbers. Like, we always think of ourselves as like the that scene in The Matrix where he sees the code.
And he's pointing out the blonde.
Right. It's like the whole world is that code, and then he puts it together as the Matrix. So like staring at that wall of numbers where nothing is intuitive and up is down, and you have no context of where you are. And by putting these things on a chart, you can say, oh, I want to sell a call spread in the stock I own. Oh, where do you want to sell it? Up near these previous highs, which just also happens to be where the expected move from the options market is. And I'm doing it 3 weeks out. And I can see perfectly that in order for this not to have been placed in the right spot, this stock needs to break out and have a new high. And I really like those odds, right? So that kind of visual trading. And I mentioned there the expected move, and some people that are like kind of into options that are listening, they might recognize that. It's called implied move and expected move. And we put that on the chart as well. We show you the future and we show you what that expected move is. And all that expected move is, it's basically like the line in a football game. And it's something that's created by all that order flow in the option market, all the way from, a Robinhood trader with $200 in his account, all the way to like Goldman Sachs. And all of that order flow is creating these expectations in the future of how much a stock could move. And by seeing that expected move, you basically are, as a trader or as an investor, you get to see that, the Ravens are favored by 7, right? Like, it would be very weird entering into a sports bet on an NFL game where you didn't know how much the one team was favored.
Right.
And the options market is doing the same thing for you. It's basically saying, this stock is about to report earnings. The options market is pricing an 8% move on earnings. And so, this Friday, this stock is either going to be 108 or 92 or somewhere in between. And it's not telling you where, like, it's not like predictive as much as it's basically telling you where everybody's lined up. And then you can look at that and decide, is the market, which side of the market am I on? Like, do I want to be a seller? Do I really think this stock's going to move $8? If not, I should be thinking credit spreads. And I should be selling credit spreads outside of that $8 expected move. And the market's basically telling me that, that's where everybody thinks it's going to move. Translating that wall of numbers into things like that visually.
Does it also show, when you're talking about the expected move, does it show you like the distribution or the breakdown of like where the bets are?
Oh, so we're actually very soon we're going to be releasing that. And so what we've got on a new version of our charts is we've got 2 really cool things. One of them is exactly what you just mentioned.
Nice.
So it would say, here's the open interest on this chart out into the future. And you'll be able to see it almost like a heat map, if you could picture that.
Yep.
Where it's like, there's a ton of calls up here in the stock, right? And what that tells me as a trader, again, none of this is predictive. It's not necessarily going to happen, but it gives you some inputs into, if the stock went up here, it's going to run into a lot of sellers, right?
Oh, right.
Because there's a lot of people that like own calls up there, and they're going to have stock to sell, right? And so that kind of, that's a layer on the chart. And we're actually working on that right now. And it should be ready in a couple of weeks. And then the other, and again, like, you could also see, you're hovering on the chart. Well, what's the probability of the stock moving up to that level? And this is all just like taking all of that well of numbers from the options market and putting it into a visual representation.
I gotta say, watching some of the videos on the options.ai website, knowing what some of these spreads were, just seeing that visual representation made it. I had wished I'd seen that at the very beginning when I was trying to figure out what they were.
Yeah, and I don't know if folks in the audience have probably seen this, and you all have definitely seen this, but an options payout diagram. I was mentioning the options chain being where the numbers go down as you go higher, and how ridiculously dumb that is. And the other thing with the options payout diagrams is they reverse the X and Y axis into where you're no longer thinking up and down, like the stock is on the X axis, right? So you're like, the stock goes higher, that's to the right on this chart, right? And so it's all very strange. And so it's like, that's not how people think. People are used to looking at stock charts. If a stock goes higher, it should go higher on a chart, not to the right or left. And that's another thing is like we took like these common option strategies and we said, can we put this onto a chart that makes sense? And we're like, yeah, we can.
That reminds me. I wanted to know how you come up with the probability percentages. I was just curious, like how that's figured out.
Yeah. So this is very basic, and this goes into, we do not want to be providing like a super proprietary figure there, because we think there are people that run those kinds of models. We think it's not that important for people to understand the basics, right? Mm-hmm. And the basics are that, let's say you have a stock that's 100 and the 100 call, that example I used earlier, is $4. The probability of that profit on that trade is based upon its break even, which is 104. And we're pulling that 104 from that expiry from the deltas of the options market, right? So the delta, we're using the delta to say that, the 104. And so let's say if it was 103.63, we're interpolating that spot as a delta.
And a delta is just...
And so delta is the definition of a delta. It's one of the basic Greeks of options. And it's basically that if I bought an option for $1 and its delta was 50, if the stock went up $1, that option would now be worth $1.50. But what it can also be used at is a probability of something happening, of the stock moving to that level.
Oh, okay.
If you look at like a $100 stock and the 110 calls are a 10 delta, it's basically telling you that there's about a 10% chance that the stock could go to 110.
I've also heard that it can be used too for hedging purposes.
Exactly.
And like the delta hedge, if it's a 30, then you need 30 shares against one call.
Exactly. So let's say you were long 1,000 like deltas of stock, which is 1,000 shares. Yeah, you're basically saying if I want to hedge this position and this option is 30 deltas, and I wanted to do it 100%, then I would need to do as many options at 30 deltas that added up to the deltas of my stock. Or to your point, like if you did a 30 delta put against stock, then you would basically, if the stock just went slightly lower, you would only be protecting 30% of your position. Now, if it went down, if the stock cratered, those deltas change, right?
Yeah, I always wondered how the market maker responds to that.
Yeah.
When the delta shoots up from 20 to 50, like, are they buying that on the way up, or is there a set time when they like are looking to balance?
So it gets mixed into this massive soup of your sort of risk, right? And so all of those, and then there's sort of like second level and third level Greeks, and those are kind of more, if you've traded long enough and you're a market maker, those kind of become intuitive. And I wouldn't recommend anybody waste their time trying to understand them. But so basically the way it works is the delta changing as the stock is going higher is what's known as gamma, right? And so your gamma risk as a market maker is one of your biggest risks. You have other risks. So you have delta risk, but most market makers are trying to stay close to delta neutral. But their gamma risk is what gets them out of delta neutral. So if a stock's 100 and they're short gamma, meaning that they've sold a ton of options, and then the stock goes to 110, they're going to be very short deltas, because basically it's the equivalent of them having been short a ton of calls. And when the stock moves, their delta is changing. And the worst possible scenario for a market maker is they've sold all of that premium and they have X amount of edge. And then the stock keeps going higher, and then it goes lower and higher and lower. And they're buying high and selling low, buying high and selling low. And then they've just lost all of that edge. And so if you all remember from the meme stock days, which were briefly back last week, right?
There's still kind of going on right now, actually.
Still kind of going on, yeah. And so in those meme stock days, one of the interesting things that was happening there is that there were so much of that like retail, small trading. It was all one direction, right? Everybody was out just buying calls, buying upside calls. And in ridiculous levels, right? So the stock would be trading 100 and people are buying like $400 calls, right? And so what would happen is there's absolutely no way for a market maker to hedge the sale of a 400 strike call on a $100 stock. They might as well ignore it until the stock goes up there, right? And so that's what was happening in those meme stocks, is the stocks were ripping higher. And then all of a sudden, like this market maker that had sold all of these really far out of the money calls, all of a sudden you're like, whoa, those are no longer far out of the money. I better start hedging those. And so how do you hedge? You start buying stock. And so those market makers were they were helping to push up those meme stocks.
Right.
So not only were they being short squeezed on the equity side, where short sellers had to then step in and buy higher, but then the options market makers were supercharging those short squeezes because they had to go in and buy stock to try to stay delta neutral. Does that make sense?
Okay. Yeah.
Yeah. So basically, if I'm a market maker and the stock's 100 and someone buys a 110 call from me, and let's say I have it at 10 deltas, I then have to go buy 10 shares of stock, right?
Yep.
But as the stock moves higher and it gets to 110, and let's say it did that overnight, I suddenly have another 40 deltas to cover, right? Because now it's a 50 delta option. And so that morning, I have to buy another 40 shares of stock against this call because I'd only bought 10 the day before against it. But now it's a different delta. And then the stock keeps going up. I keep having to buy that other 50 until eventually I'm completely neutral. And then the stock goes the other way and I have to start selling it, right?
So is it worth paying attention to the open interest and options just to see if those things might happen? Yeah,
and that's sort of what I was mentioning about that layer when you brought up, like, can you see where people's bets are in the future? That's where it gets kind of interesting, because you're like, man, if it goes... When I look at like options open interest, and especially on like a Thursday or Friday, there's some times when you can predict a stock like pinning. Do you all know what that means?
Where it doesn't really move?
Yeah, and it pins like exactly on a strike.
Right.
And it's basically because of everything I just described of like, the stock goes higher. There's stock to think about it in the opposite direction. Let's say a market maker is really long a 100 strike, and then the stock goes higher. They have stock to sell. And then the stock is lower, they have stock to buy. And what ends up happening is if the whole market is positioned that way, it's almost like that Pong.
Yeah.
It keeps getting closer and closer and closer until it expires. And that's why a lot of times you'll see a stock finish like exactly on the strike on a Friday.
Right.
And it's because that's just pinned. And that's what's happening.
It's getting pinned so everybody ends at neutral. That's the neutral point.
Exactly. They're saying by the end of the day, in the last 10 minutes, the stock goes to 105 cents and they have stock to sell, and then it goes down 10 cents and now it's 99.95 and they've stock to buy.
Right.
And then that just works like this like trash compactor down to the strike, and it's just compressing it down to that strike.
So it's not necessarily something nefarious then.
No.
Like trying to keep a strike from exercising the money. It's more just the nature of the hedging.
A weird market inefficiency. And there's a bunch of those types of things. Like that meme stock gamma squeeze is one of them. I mean, short squeezes in general are a really weird market inefficiency.
What is a gamma squeeze?
So a gamma squeeze is what I was describing, where if the stock was ripping higher and all of all of those market makers were short, like upside calls, they keep having to buy stock to stay delta neutral. And so it's basically they're the ones powering the stock higher at some point.
Okay, so you're a market maker then, or were. So stocks trading at, let's say, $16. Like, at which strike would you start deciding, like, oh shit, I need to start getting some shares of this in order to hedge it? Like, what would be the gamma turning point for you?
So ideally, you're doing it in real time, right? So in a really efficient system, every 10-cent tick higher, you're buying like a small little amount. But the reality of the situation is that stocks gap, right? They gap on the opening.
Yeah.
And so what ends up happening is you have a choice to make, right? So let's say you were short gamma and an earnings comes out and the stock's up $10. You could either cover all of those new short deltas that have been created at that moment, or you could, roll the dice a little bit and see if it comes in a couple of dollars and see really a better level, right? So you're constantly living as a market maker with those kinds of real-time decisions where you're like, do I do it all at once? Because the worst thing that can happen is the stock gaps $10 higher. You buy a bunch of stock and then it immediately comes in $5 because guess what you're doing there? You're selling stock. So you've now bought high and sold low. But what you're supposed to be doing is theoretically you should be doing it every penny.
It just seems like it's like a positive feedback loop. Like if the options market is very thick or there's a lot of interest in there. It just seems like that extra added buying pressure every time a call changes hands, like should just, like, how do you arrest that? Like, that seems like that could just really create a parabolic move.
Yeah, and I think if people are, that are listening, if they really want to get into options and if they want to dive deeper, I always recommend. I remember when I was training, so we trained for about a year before they let us, be a trader. So you're basically an assistant.
They don't just throw you in.
Yeah, no, they don't throw you in. And so here's $1 million. Good luck.
Exactly.
So you're training, you're an assistant. So, right, you're witnessing a bunch of stuff you don't understand yet. And then you're getting like a phone thrown at your head when you screw up. And then you are, after the close, there's like at least at my firm, there was a traditional education aspect for all of the trainees, right? And I remember you just remember those kind of light bulb moments because at first, like, none of it makes sense, right? Like, I think I didn't even know the difference between like a bid and an ask coming out of college, right? I was like, what?
I thought you were going to say on your first day.
Right? Like, that's one of the first concepts, like, like when you're trading, you're like, wait, what?
Yeah.
I don't get that. And then it dawns on you what's going on there. So it's the same thing. And when you're learning options, there's a couple of light bulb moments. And one of the things that I think was sort of the next level realization of like how options really work is if you understand. So let's say, using an example, $100 stock and a 104 call. A $104 stock. Okay. And a 100 call is trading $5, right?
Yep.
That means $4 of that is what it's worth, what it will be worth at expiration if the stock finished at 104, right? That extra dollar is everything about options.
Yeah.
So that extra dollar is what we used to call the premium, right? We would call it but it's like extrinsic premium, right? The $4 is the intrinsic premium. It's what it's worth. That extra dollar is extrinsic premium. That extra dollar, if you understand how that works, is you understand everything about options. And it's basically all of the time value, all of those Greeks, all of the uncertainty priced into how much it's worth, that trader or that investor to have that kind of, a position for that uncertainty. And so what I always told people, and I remember this light bulb moment, is we would do this mock trading exercise. And I remember one of them was, basically trading into that last minute of expiration and understanding how quickly that $1 collapses. Right?
Yes.
It's not linear. And it's basically, going back to the horse racing analogy, you're betting all the way through the race, but like in that last couple of lengths of that horse race, it's unless somebody breaks a leg, right?
Right.
It's kind of obvious what's going to happen in that race. And all of that premium for all that uncertainty starts to evaporate really quickly. And so I always recommend to people just pull up like a SPY options, like the money SPY options, and watch like the last 15 minutes of expiration Friday. And if you understand that sort of ebb and flow of like as the stock's moving around a little bit and you understand all of that premium collapsing, it's really eye-opening.
Especially if you can find one that's being pinned and watch that one evaporate.
Oh yeah, that would be the best. And you'll be able. It's funny, like even people at home, they'll be like, "Oh, this thing's gonna pin." I can tell, and it'll basically be they see the stock every time it gets above the strike, immediately gets sold, and every time it gets below the strike, it immediately gets bought. And you're like, you can kind of see what's going on. Yeah,
I'll have to start paying attention to that.
Exactly. Yeah.
Do indexes ever get pinned?
Oh yeah. Totally. Yeah. And especially, and that's what really fascinating because a lot of times this happens around big whole numbers. So if you're looking at like an ETF or an index, the obviously the at the money strikes are always going to be the most open interest and biggest volume. But then you'll see stuff at levels, right? You'll see the low from a couple of weeks ago in the SPY. I'm sure it has a bunch of open interest. And then the previous highs, I'm sure, has a bunch of open interest. The other thing you see in particularly, you see it in ETFs and then individual stocks is you see big round numbers. So like Tesla, like every 800, 900, 700 strike always seems to attract a bunch of attention. And so those are very fascinating. If you're watching a stock like Tesla and it's expiration Friday and it's trading 695, there's a pretty good chance it's going to finish right at 700. Because there's a bunch of that gamma, like sort of drawing it like sirens to the rocks. And that's all these weird effects that options expiration has, is like all of those Greeks are intensifying into that last hour of trading.
So I'm just looking at the options chain on Tesla, 13,000 at 500, 2,000 at 400, 4,000 at 450.
I'm sure there's a ton at 1,000 now. Right.
Let's see. I haven't gotten.
Yeah.
Didn't get that high. Oh yeah, 18,000.
Yeah, exactly.
Yep.
And that's a lot of people. So no, that 18,000 is interesting because it's a mix of institutional traders that are long this stock, institutional, hedge funds and that kind of thing. And they're probably selling that 1,000 strike, right? Against all of the stock they own. And then there's a bunch of retail traders that are buying that 1,000 strike and being like, what if?
Yeah.
Right? And they're kind of on the other side. And so that's like, when we were, taking it back to institutional order flow looks very different than retail order flow. And that explanation about multi-leg and single leg, my co-founder of Options AI, he is from the institutional brokerage side, and he jokes, he's like, I never saw a single leg options trade from institutional customers, which he was representing. Oh. Because they, and if it was probably against something, right? So if they're out selling a call or buying a call, it's probably like a hedge or adding income to something else. If they're going out and they're like, I think Tesla's going higher, they're doing it in multi-leg option strategies.
So when I see a call sweep from like Benzinga, like on their options alerts,
almost always a spread.
More than likely, that's more than just that leg. There's something else that should be paired with.
Yeah, they're either rolling something or you should look for surrounding strikes to make sure that there wasn't another side to it, right?
Gotcha.
And, and then again, you have to figure out like whether they're opening and closing. It's complicated. Right. But the institutional order flow is, it's almost all multi-leg. And at Options AI, our order flow is over 85% multi-leg options. We were in an article with CNBC a few months ago where they mentioned that Robinhood's is 99% single leg. And not to bash Robinhood, I think Robinhood has,
Oh no, you can.
You go ahead. We bash them all the time.
We'll do it for you if you want.
Sickest UX I've ever seen. It's so easy to use and everything like that.
They gamify things so nicely.
But 99% of their order flow in options is single leg, which means it's all people doing lottery tickets.
Yep.
And so that is exactly what we are trying to be, the place that people graduate to. And it's like, all right, well, that stopped working.
Right.
At some point, the market got more complicated than just going higher every day because a bunch of people wanted it to. Now what? And it's like, oh, well, now I've got to think differently and I've got to do some of these more high probability strategies. And that's what we sort of see ourselves as, you could graduate from a Robinhood, or you could be, staring at a wall of numbers at a legacy brokerage and be like, this should be more intuitive. Mm-hmm. And that's where we hope to meet those people.
And one more time for everybody, where can they find that?
Yeah, so you can go to optionsai.com. They can follow on, I am Options Learn on Twitter. And also by my name, I almost screwed that up. On my, by name, they can find me on Reddit and things like that. And then, we have a Learn Options blog where we write about it and do some educational videos and things. We are about to launch, title pending, but it's something basically like an options university. And what we want this to be is like a 9 or 10 very short video course in quotes, like you don't have to do anything. But basically that you should start and be able to watch these videos and really like a half an hour later understand credit spreads, debit spreads, some of these common option strategies in a way where you're like, okay, I understand. I think I could apply this to, my everyday investing. There's no reason I shouldn't be using some of these things to add income, or there's alternate ways, higher probability ways for me to express a bullish view or a bearish view and things like that. And that's coming soon in the next few weeks.
Well, there is an options university on your website. I was looking at it this morning.
Yeah, and it's about to get a lot better. Yeah.
Oh, that's awesome, because the stuff that's on there right now looks really solid. In fact, I was gonna.
Yeah, and I'm literally recording videos as we, as soon as I get off this.
Don't trade like these guys.
We're trying to boil it down like real quickly, and I did a video the other day that was, I think it's like less than 3 minutes long, where I basically explain the difference between a debit spread and a credit spread. And I'm like, that's, comparative to, buying in a book on options and things. Like, people should be able to understand this very quickly.
Yes.
I have trusted people.
I think you did a fantastic job with the stuff I've seen on there so far. And in fact, I'm probably going to add some of these links to our resource page.
And go into where you are. There's a place where I think I have like the 6 strategies.
Yep.
Yeah,
go look at it right now.
Those are real quick, like 30-some second videos.
Yep. Which
is an attempt to explain an iron condor in 30 seconds. And it's like, if we can explain an iron condor in 30 seconds, you can do an iron condor.
Yes.
Yeah.
You do such a good job with that. I'm wondering what do I need to start up an account with Options AI?
Well, so
start trading.
Yeah, so it's a brokerage account, and so you have to do an application, and you have to say all of those required things, and then what we would say with any brokerage account, we are level 3 options. And what I was explaining earlier is that's intended for people that have bought calls and bought puts and are willing to say that I have some experience in options and I have some experience in traders. So people are going to be familiar with those application forms. And then what I would say is that we plan on in September, that's why I was saying that this thing's coming in a couple of weeks. It's all tied to the fact that we are going to launch a subscription service. So for a small amount of money, and by small, I mean, it's going to be like maybe like $20 a month or something. We haven't decided, but it's basically you get all of this tooling and all, and you don't need the brokerage account. And that opens us up geographically into places like Canada and all that we can't operate in as a brokerage only. Mm-hmm. But it also just, if people are like, I'm curious, I want to learn these things. And, we want to put it at a dollar spot that it's like, Netflix. Like you're like, oh, that's nothing, right?
Right.
And so we want to put it at that. And the reason we even have to charge is it's real time. It'll be real time data. And
Okay.
Basically, every person that signs up for real time data, we have to pay all the exchanges, and the exchanges charge a ton. It's ridiculous. So
it's like another like flow feed or
exactly, yeah. So if you like literally, we have to tell all of the exchanges how many people accessed real time data like every month and all.
Mm-hmm.
And then we get a big bill.
Oh man. Can't just get one Bloomberg terminal and
call it. No, you're in a lot of trouble. And in fact,
I know.
Speaking of that, is like if you're a professional and you're opening up a retail brokerage account and you're like a registered, you have like a Series 7, at some company, then that gets put into a separate bucket where you get charged like Bloomberg type prices per month for real time data. So it's all very fascinating. It's all very old school.
Interesting.
Yeah.
All right. Well, Dan, you got anything else for Mr. Lagator here?
No, this has
Lagator.
Did
I say that right?
Lagator. This has been phenomenal insights into the market today. I'm going to have to re-listen and take better notes.
I'm going to do it all in the form of 30-second videos for you.
I think we may have to try to do another one of these recordings and maybe just do like more of a deep dive into the different option strategies.
Yeah.
Oh, that'd be really fun.
Yeah. We could talk markets too. Like we could, be like, oh, this would be an interesting strategy in this stock right now.
Right.
Yeah. Okay.
I like it. Should we wrap this up and let Mr. CC here go and actually make some of these more content?
Get back to work.
He's promised everybody. Not enough time screwing around in the China shop. No time to get back to real work.
We thank you very sincerely, CC, for stopping by. This has been an incredible conversation, and we do need to schedule another one. That's going to be great.
Let's do it. Appreciate having me on.
Excellent. Folks, thanks for sticking around to the end. We hope you learned something. I know I learned lots of things today about hedging and market maker behavior. Loving those insights and really, really enjoying the education on Options Day AI. Check that out. You can find CC like he said at Options Learn on Twitter or options.ai. We are closing up shop, though, and we got to go. But we'll be back at you soon with another exciting episode. And until then, happy trades.
Bye.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.